Hi everybody. This is the second lecture for this topic number 9. This topic is about budgeting. In the previous video lecture, you have been you have seen the definition of budgeting or definition of budget, and then you have seen the benefits of using budget for a business, and then you have seen the effect of budget on behavior, on employees' behavior. So in this second video lecture, you will see types of budgets. Okay, that is the main thing. Okay, let's see this slide. See this objective to describe the basic elements of the budget process, the two major types of budgeting, and the use of computers in budgeting. Okay, so let's see. So this is the first thing that you have to know. Budgeting systems. There are two budgeting systems, I think, according to these lecture notes. A variation of fiscal year budgeting called continuous budgeting maintains a 12-month projection into the future. Okay, this kind of system is called continuous budgeting. And this system, if a business uses this system, the business at all time has a 1-year budget. Okay. So if a business uses a continuous budgeting system, then the thing is like this. The business at all time will have a 1-year budget. So the thing is like this. The practice of budgeting is like this. Before a new year is started, a business always or has prepared a budget. Has to prepare a budget. So most of the time, the budget will cover 1 year. So let's say now, let's say now it is December 2021. Let's say. So if a business uses a continuous budgeting system, then the business has to prepare a budget for year 2022. The budget will cover from January 2022 to December 2022. And then when the month of January 2022 is started, the business will use the budget. And then at the end of January 2022, the business will prepare budget for January 2023. So when the February 2022 is started, the business already has 1-year budget from February 2021 to January from January 2022 to from February 2022 to January 2023. And then at the end of February 2022, the business will prepare budget up to February 2023. So at all time, the business will have 1-year budget. So that kind of practice, budgeting practice, is called continuous budgeting. So the alternative budgeting system is called zero-based budgeting. Zero-based budgeting requires manager to estimate sales, production, and other operating data as though operations are being started for the first time. So this zero-based budgeting is like this. Before a new year is started, a business will prepare budget for next year. let's say now it is December 2021, let's say. So the business will prepare a budget for year 2022. When the year 2022 is started, the business will use the budget. And at the end of year 2022, again the business will prepare a new budget. A new budget for year 2023. And then when the year 2023 is started, the business will use the budget until at the end of year 2023. At the end of year 2023, the business will prepare a new budget for year 2024. So this kind of practice or system is called zero-based budgeting. Zero-based budgeting means the business will prepare a new budget before a new year is started. Every year the same thing. It started from zero. Okay, so that is the difference between continuous budgeting system and zero-based budgeting system. Okay, now, and then here you will learn about two types of budget that can be used by a business. The first one is called static budget. So let's see here. A static budget shows the expected result of a responsibility center for one activity level only. The budget does not change even if the activity changes. A static budget is simple. Before a new year or a new month is started, a business or a department in the business will prepare a budget for next month or next year. The thing is like this, let's say. A static budget is used by many service companies and for some admin functions of manufacturing companies. Okay, you will see. Okay, I will show you the sample of a static budget. This is a static budget for an assembly department in a business. So this is like an old example, year 2008, but this one is supposed to be from a new book, a new textbook, but I think supposed to be 2018 maybe. Okay, so this is a static budget. So the date is ending July for the year ending July 31st, 2000 something. So let's say if a business uses a static budget, then this is the format of the budget. The business will show expected figure for items related to the budget. In this example, the budget is cost for assembly department. So the budget for direct labor, the budgeted amount or the expected amount is 40,000 for direct labor. Electricity, $5,000. Supervisor salary, $15,000. So total department budgeted cost is 60,000 for year ending. In this example, 2008. So this is easy. Let's say you are a manager or a management accountant, and then you use static budget, then it is easy. You just estimate what is the cost that you will have to pay in the next accounting year or in the next month, and then you put the number and you use the budget. Okay, let's see the strength and weakness of static budget. The strength first. The strength, static budget is simple. All expenses are budgeted as fixed cost. You just estimate for every cost what is the expected amount that the business has to pay. But the weakness is, let's see here, the second point, the weakness, a static budget does not adjust for changes in revenues and expenses that occur as volume change. When you prepare a static budget, you put the estimated cost, etc. The good thing is it is simple and easy, but the weakness is if the quantity of production is different compared to your expected quantity of production, then the number does not change. The number is fixed, so it is a weakness. So the opposite of static budget is called flexible budget. Flexible budget, see here, flexible budget shows the expected result of a responsibility center for several activity levels. And then second point is a flexible budget is especially useful in estimating and controlling factory costs and operating expenses. Okay, I hope there is an example. Okay, this is a flexible budget. So you can see here, the flexible budget is a bit complex because a flexible budget considers several levels of quantity of production or activity of production. In this example, you can see here, the budget is for the same department. You have seen static budget for assembly department. Now, the same department, but here the department uses flexible budget. So when the department uses a flexible budget, you can see here, the department will show the number at several level of activities or several unit of production. See here, the first heading in this budget is level 1, level 2 and level 3. So level 1 is 8,000 units of production, level 2 9,000 units of production, level 3 10,000 units of production. And then in this budget, the budget shows the 3 different budgeted costs for 3 different level of production. Level 1, you see the last item in the budget. Level 1 total department budgeted cost is 60,000. Level 2, when if the production is 9,000 units, then the expected or budgeted cost is 65,500. Level 3, 10,000 units of production, the budgeted cost is 71,000. Okay, when a business uses flexible budget, the business has to divide the cost into variable cost and fixed cost. You can see here in the second column, you can see a list of variable costs and a list of fixed costs. For example, here the variable cost is direct labor. Direct labor is $5 per unit. And then electricity, 50 cents per unit. That is variable cost. So if the level of production is level 1, direct labor $5 per unit times 8,000 unit of product. So equal to $40,000 cost, budgeted cost. Electricity, 50 cents per unit times 8,000 units. So you can see at level 1, the budgeted electricity cost is $4,000. Okay, but you see the list of fixed costs. The list of fixed costs are same, even though there are changes in the quantity of production. So you can see here, at level 1, the electricity cost is 1,000. Level 2 is same, 1,000. Level 3 also same, 1,000, because the electricity 1,000 here is the fixed cost. It will not change even though the quantity of production changes. Total fixed costs are same at different level of production. Okay, so the good thing about flexible budget is the budget will change when the quantity of production changes. So If a department produces more, then the department can expect higher cost. If a department produces less, then the department can expect low cost. So they can see here, let's see. Okay, see here, there are strengths and weaknesses of flexible budget. The strength is flexible budget provides information needed to analyze the impact of volume changes on actual operating results. The weakness is flexible budget requires greater research into costs. There must be a differentiation between fixed and variable costs. So, the good thing about flexible budget is you can see the budgeted cost at different level of production or at different activities of production. This is good. If you are a manager, you want to see what will happen if the quantity of production increase and what will happen to the cost if the quantity of production decrease. So that is the good thing about flexible budget compared to the static budget. If you can remember, the static budget, the budget is fixed. It is like that. No matter how many, it does not consider the changes in the quantity of production. Okay, the weakness of using flexible budget is it is difficult to prepare. More difficult compared to static budget. Because first, when you want to prepare a flexible budget, first you have to categorize the cost into variable cost and fixed cost. If you are working in a business, it is not easy to categorize cost into fixed cost and variable cost, because if you work in a business, there are many costs. In this sample question, it is like 4 items only, but in a real business, maybe 20, 30, even 100 types of cost. So very difficult to identify which one is fixed cost, which one is variable cost. Sometimes the cost has mixed component. One cost has fixed and also has variable component. So that is one thing. So that is the main weakness of a flexible budget. In this course, you have to know how to prepare a flexible budget. Okay, I will show you how. Okay, this is a sample question. Just see this sample question. If Coulter Manufacturing Company Assembly Department spends 72,000 to produce 10,000 units, how much over or under budget will the department manager be using a static budget and a flexible budget? So, if somebody asks you which budget is better, static budget or flexible budget, so the general answer is static budget is better compared to the general answer is flexible budget is better compared to static budget, because flexible budget considers different level of quantity or activity of production. This sample scenario shows how flexible budget is better compared to static budget. Okay, see, if Coulter Manufacturing Company Assembly Department spends 72,000 to produce 10,000 units, how much over or under budget would the department manager be using static budget and flexible budget? So you can see here. Okay, if the management uses static budget, the actual result is 72,000. The budgeted cost is 60,000. So if you compare, you will see that the difference is the department is at $12,000 over budget. Okay, this situation happen if the business uses static budget. Remember, one of the thing that you can use budget is at the end of one accounting year, or at the end of uh, a month or something, you can compare the actual data and budgeted data. In this situation, the actual data or actual cost is 12,000 higher compared to the budgeted cost. So it shows unfavorable situation. The department has spent $12,000 more than the budget. Okay, this is if the business uses or the department uses static budget. But if the department uses flexible budget, then you can see here, flexible budget, it considers different level of activities or different quantity of production. So the actual result is $72,000 cost. That cost is related to 10,000 unit of production. So when you prepare flexible budget, you compare this actual result or cost with the budgeted cost for 10,000 units of production. So you can see here, if you use flexible budget, then the comparison is better. The comparison is a good comparison. The comparison is between actual cost of producing 10,000 units with the budgeted cost of producing 10,000 units. Now the difference is only 1,000, unfavorable. So the conclusion that you can make from this number or budget is better compared to if you use the static budget. If you use the static budget, the difference is $12,000 unfavorable. Then you will say the department is very bad. But if you use flexible budget, then you can see the difference only $1,000 unfavorable. It means that the department is actually not bad, not too bad. $1,000 difference is not too bad. So it shows that flexible budget is better. It helps manager to make better conclusion about the department. Okay, this is a sample question related to flexible budget, I think. So let's see. At the beginning of the period, the assembly department budgeted direct labor of $45,000 and supervisor salary of $30,000 for 5,000 hours of production. The department actually completed 6,000 hours of production. Determine the budget for the department, assuming that it uses flexible budget. So, like I said earlier, flexible budget, when you prepare a flexible budget, you have to show different level of quantity of production, and then also you have to categorize the cost into fixed, variable cost and fixed cost. So to answer this question, the thing is like this. So when you calculate the budgeted cost using a flexible budget approach, you have to divide or categorize the cost into variable and fixed cost. So the variable cost is direct labor hour, 6,000 hour times $9 per hour. So the budgeted cost for direct labor is 54,000. Fixed cost is fixed. Supervisor salary 30,000. For the direct labor, how can you get the $9 per hour? $9 per hour is $45,000 divided by 5,000 hours. You can refer to the question in the previous slide. Okay, I have a video. that explain how to prepare a flexible budget. I will share with you the video later. I will share with you. Okay, this is the last thing. Actually, the syllabus for this course does not include this one, but I just want to introduce you to this one because this is very important. In the future, you maybe you will work in a company, and then maybe you will become a manager. So this is very important. One of the most important thing related to budget is this one, master budget. In master budget is a budget that can be used by a business, and this budget covers everything related uh, to to a business. Okay, so master budget is like this. Okay, this is this one. Okay, this is shows everything about master budget. Okay, master budget is the main budget that can be used by a business. Master budget covers everything. In this chart, you can see a master budget for a manufacturing business. Okay, so master budget is started with sales budget. See, the first box is the blue box here in this slide is the sales budget. So master budget is started with preparing a sales budget. Why sales budget? Because sales budget the operation of a business depends on the quantity of sales. The higher the quantity of sales, the higher the activities. When the quantity of sales is high, the production, there are many things to be done for the production, more, and then more have to be done for the marketing and management, and more profit and more cost, etc. More revenue. So everything is depend on sales. So that's why when a business prepare a master budget, the business has to prepare sales budget first. Okay, the logic is like this. So a master budget, like I said earlier, covers almost everything in the business. It related to the production, etc. And then the last budget in the master budget is the budgeted income statement. The budgeted income statement will show the total revenue, and then minus total cost, and then you will get the expected or budgeted profit or loss. So the master budget is started with preparing a sales budget. Let's say you have a business and then you want to use master budget for your business. So the first thing to do is you have to prepare a sales budget. So let's say you want to prepare master budget for next month. So now you have to expect how many units of sales you will make next month. Let's say you think that next month you will sell 15,000 units of product. So after you have that number of expected sales, then you can prepare a sales budget. Sales budget is a budget that show you how many quantity of sales and how much revenue your business can get in the next month. And then after you have prepared a sales budget, you can do the next thing. The next thing is you prepare the production budget. Let's say you think that you will sell 15,000 units of product next month. Then the next thing, you prepare the production budget. You have to budget how many products you will sell. Sorry, how many products you will produce next month or manufacture next month. So if your business expect to sell 15,000 units of product next month, you will produce a bit more because you want to keep some stock or inventories. So let's say you will produce 17,000 unit product. You will sell 15,000, you will produce 17,000. After you know how many unit you will produce next month, then you can prepare budget for direct material, budget for direct labor, and budget for overhead. You can see the yellow boxes there. After you have prepared the budget for direct material, direct labor, and overhead, you can prepare budget for cost of goods sold budget. And then after that, you can prepare the income statement budget. Sales budget is related to selling and admin expenses budget. After you know how many product you will sell, you can calculate how many costs you will have to pay for selling and admin expenses. So after that, you can prepare the last budget in the master budget. In the last budget in the master budget, which is the budgeted income statement, to know the expected profit or loss for your business. Okay, this is the end of the topic number 9. I just want to summarize everything. So the first thing is, you have for this topic, you have to know the definition of budget. The second thing is, you have to know the benefits of preparing or using budget for a business. And then you have to know what are the effect of budget, or how budget can affect behavior, particularly the behavior of employees. Sometimes the budget can increase the motivation of employees. Sometimes it can dampen motivation of employees. So I have explained that in the previous lecture. After that, you have to know types of budget. And there are 4 things that we have discussed for the type of budget. First, zero-based budgeting, and then continuous-based budgeting, and then static budget, and then flexible budget. For flexible budget, you have to know how to prepare a flexible budget, and why flexible budget is set as better compared to static budget. And the last thing in this topic is I introduce you to master budget. It is not covered by the syllabus of this topic, but it is very important. If you have time, you read about master budget, because it is very useful in the future when you work. Maybe the company that you are working in uses master budget. Thank you very much. Do not forget to write your name in metric number in the comment section. I will take them as the lecture attendance.